last year, we saw almost all major international markets outperform the US. And, after 15 years of having outperformance, now other markets, I think, will catch up on the US market because in terms of valuations, the US is a bit more expensive than other markets.
So, David, share with our listeners and viewers why we're starting to diversify our personal investments a little bit away from the United States.
Yeah, well, international markets have outperformed US markets. And since the beginning of 2025, it seems like a lot of US once closest allies have slowly began selling US treasuries and have talked about repatriating their gold. And that leads us to today's guest.
Welcome to Living Not So Fabulously, where we make heads or tails of stock market and demystify cross-border investing for international investors.
Pedro Lino is the Lisbon-based CEO and CIO of Optimized Investment Partners with a passion for global asset management and Golden Visa investment solutions.
A seasoned economist with a degree from Nova School of Business and Economics and leadership roles in Optimize and DIF Broker, Pedro also serves on the Portuguese Diaspora Council and helps demystify cross-border investing for international investors. Welcome to the show, Pedro.
Thank you so much for having me on the show.
Of course, we're happy to have you. So many Americans still sort of assume that the U.S. always wins in investing these days. Why is that belief becoming more outdated, would you say?
Well, first of all, the US hasn't stopped being innovative. What happened is that it's much more concentrated, expensive, and more cyclical. Non-US assets often trade at lower multiples, especially because the last 15 years, the US market performed really, really well. But last year, we saw almost all major international markets outperform the US. And, after 15 years of having outperformance, now other markets, I think, will catch up on the US market because in terms of valuations, the US is a bit more expensive than other markets. So I think on top of that, there is also some loss of confidence, as you mentioned, and trust in the US asset, basically due to the high debt and some policy changes that we had in 2025.
Yeah. So to your point, data shows that despite the S&P 500 rising about 17% last year, the U.S. didn't even rank among the top 10. I think it was even lower than that.
Yeah.
In returns for similarly sized economies and markets. When we say global markets outperformed, what did that look like more specifically? And which regions are you seeing that are doing the outperforming the most?
So last year, it was an exceptional year. Europe did much better than the US, around 15% in euros. When translating to dollars, more than 30% because the dollar was down to around 14, 15% against the euro. But even within Europe, Southern European was much better than the major and developed European markets. For example, Portugal, Spain, and Italy, they outperformed and they returned over 30% in euros. And why is that? Because over the last, 13 years ago, we had the intervention of the IMF in Europe. There was the European debt crisis, and Portugal, Spain, and Italy, they had to reform their economies, and now they are growing a lot. So financial utilities, and tourism and energy transition were the keys for the success last year. Also, China, Japan, Latin America, and some emerging markets were the big outperformers last year. I think it's all about the quality at the discount. And as I mentioned, the other markets were trading at a discount, and I think now investors are paying attention to them.
Yeah, so if you're just tuning in, this is Living Not So Fabulously, where we mix international investing with a spoonful of reality. We're speaking with Optimized Investment Partners CEO and CIO, Pedro Lino. So you've touched on this a little bit in your last answer. How have tariffs, trade uncertainty, diplomatic volatility here in the United States affected U.S. stocks, specifically on a global stage?
Well, policy friction and uncertainty raises equity risk premium. And what happened last year with the tariffs, inflation risk increased, margin pressure in companies also increased because the companies faced tariffs, and some of them had to absorb a percentage of those tariffs. Also, trade fragmentation undermines global supply efficiency. So what happened was a change in the global trade that we thought we had it right over the last decades or so. And with all this diplomatic volatility, this increases the policy risk. It's not only the market risk that is increasing, but also the policy risk. So what I think is that people are starting to quietly reallocate their capital, especially in the US, and especially many Americans that have at great decades of returns.
Yeah, so Pedro, it sounds to me like what you're saying is that especially for American investors, we're starting to see the effects of uncertainty broaden out. There's always been a level of uncertainty in markets, right? But it seems like this is now broadening out to something that's a little bit more geopolitical, um, and uh, and that additional risk means that individuals are probably going to be expecting a better return. When there's more risk, they want a higher return. Do you think that that's one of the real headwinds that or the reasons why Americans may be looking to other markets, is that they're just basically saying I'm going to take a step back from US investing?
Yeah, look, this kind of risk is a bit different because if you have political risk or uncertainty about trade policies, this risk is not a good one. It's the one that creates volatility, and after the decade of outperforming and excellent returns, it might end with some years with not so good returns. For example, the last 3 years for the S&P 500, you had appreciation of more than double digits, which was excellent. But now, with all this uncertainty, what we have is fewer foreign buyers of, for example, treasury bonds. As you mentioned, for example, the Danish pension fund, they sold all the treasuries that they have. Of course, it's only 100 billion, but there is the intention and the reputation that the dollar is now having, which is not a good one. So if you have long-term partners, especially European partners that are now selling dollar, then the demand for the dollar weaken, and that means that the bond yields rise. And what the Fed can do, they can control interest rates on the short term, but not on the long term. And what you are seeing that long-term interest rates, especially the 10-year on even the 30-year yield, they are at the highs of the last years. So you have the 30-year yield at around 5%, 4.8 and 5%, which is really, really high. And basically, if the demand of dollar falls, then this yield will be maintained high. So what I think is that uh, global investors are trimming their allocations in the US because they were really overweight. And what they are now doing is also diversifying from US dollar assets indirectly through ETFs, international ETFs, but also through dual custody. Many clients are now jumping into Portugal or other jurisdictions to buy European assets. And basically, they can use it directly, they can invest directly, or some of them use their IRA account. But the what is most important is that American investors are waking up into this diversification outside the US.
So I'm curious, Pedro, your opinion on you're mentioning a lot of variables as to why international markets are becoming more appealing to all investors, U.S. investors as well as international investors. But the United States having too much debt is not a new problem. The United States having high inflation has been kind of the norm since 2020, as is much of the globe. So some of these variables have been around for years. Um, there seems to be one variable that is relatively new. And it's after watching Davos last week, as of the time of this recording, it was last week. It almost seems like there's one variable that has finally told everybody, hey, we've got to reposition our investing strategy. We've got to reposition ourselves financially as individuals and as companies. Would you agree that we probably wouldn't be here had we had a different outcome in the 2025 or 2024 election?
Well, in terms of policy intensity, for sure. Because what happened last year, if you take a look, after the tariffs were imposed, March last year, it was when the dollar started to drop. And it dropped 14% after after that policy change, which affected the Europeans, and not only the Europeans, but that the largest trade partners with the US. And for some reason, some countries that are not aligned with the US were not imposed so high tariffs. So that changed the approach of the partners and the allies that were traditional allies from the US. And what happened is that after that change in policy, which is a more stronger policy and many times against the allies, the dollar started to fall. So I do think that the outcome of the election actually started a new era for us in Europe. We will have to get used to it because it is become more difficult to manage sometimes the different messages that you get every day. Sometimes it's left, the next day it's right. But look, we have to keep focus, and in terms of managing our portfolios, what we have to understand is how we can protect from the uncertainty and volatility. So we had the tariffs that were imposed on that actually made imported goods much more expensive for the US. And now what I think the administration wants is the second derivative, which is the dollar devaluation, because it's the only way that they can tackle the trade deficit gap that, as you mentioned, it has been for a while. But the first step, I think, it was tariffs, and the second one is dollar devaluation, because it's the only way that I think they will have to balance the trade. But look, for US for American investors, this will not be good, because actually what you're doing, you are losing purchasing power when comparing with other countries. It's not the end of the world, because if you take into perspective the last 25 years, the dollar was trading at as low as I think 62 cents on the euro. Now it's trading at around 80 something cents. But what I think it will happen in the next year or so is that we can go down to 71 cents. So I think that the dollar will come down 50% more. And basically, John and David, it's due to this uncertainty and the lack of buying of US assets, especially from long-term allies.
Gotcha. So one moment, Pedro. We'll be right back after this quick break. Welcome back to Living Not So Fabulously. We're back talking with Optimized Investment Partner CEO and CIO Pedro Lino. So, Pedro, based on what you're seeing today, how do you expect international markets to perform relative to U.S. markets starting in 2026 and beyond? You just gave us a prognostication for the dollar. What about the stocks?
Well, I think that we should expect the trends that we saw in 2025 to proceed. So I would expect a relative outperformance outside the US comparing with the US, even though the absolute return in the US markets might remain positive. I have to remember that the US market had 3 exceptional years with more than double-digit returns. But I still think that the US market can close the year higher. But you have these 2 risks: the dollar devaluation and also the uncertainty of the policy that's why I think Europe, Japan will be beneficiary, even because their valuations are really low. So there is a re-rating of these valuations, and also some selective emerging markets, for example, Argentina, India, and even China. So I think that the next decade will not be anti-US. It will be much more like pro-diversification. And I think it is the right thing for an investor to do, is protect themselves, and diversification. I think it's the key.
Absolutely.
Yeah. So Pedro, just out of curiosity, you talked about the dollar continuing to drop, and we know that you are an investment professional in Portugal, and it seems like Portugal has attracted a lot of attention. Does the fact that the dollar continues to drop mean that holdings in foreign countries like the Portuguese market, when the dollar drops, that the value of those assets go up in proportion to the dollar dropping, even if that market doesn't actually outperform the US? There's a possibility it's still, you as an investor could still outperform the US just because of the drop in the dollar.
That's absolutely right. So
Good job.
even if even even if the European markets go return zero, if you have a depreciation of the dollar around 15%, as a US investor, actually you are making 15% because of the Forex, the foreign exchange. So yes, you are absolutely right. So in a time, and if we predict that in the next couple of years the dollar will go down, which I think it will, um, and going down, it doesn't mean a crash. It means that a correction. We had the dollar coming up and appreciating over the last, I think, 18 years. So since 2008, the dollar has been appreciating against the euro. So it's time also that the dollar takes a breath. And I think that US investors must take that into consideration. And if they invest abroad, even if those markets return zero, you are making money.
So then, because it seems like Portugal has been an attractor in this. I think the Portuguese market was, what I saw was the number three performing market in the globe. What do you think is the reason why there are assets flowing into Portugal versus maybe some other countries?
Well, Portugal combines stability, access, and also undervaluation. It's a rare trio, and basically, Portugal is a peripheral market within the European Union. So it always trades at the discounts regarding the major markets, major European markets. But the companies are very good companies. We have very well managed companies that pay also very nice dividends, because as we are a peripheral market, the companies, in order to attract pension funds and investment funds like BlackRock, the Norwegian Central Bank, they pay very good dividends. So we have companies that actually pay between 5 to 8% dividend in euros per year. So that's what makes this market a small gem that is being discovered by international funds and also some by pension funds. And the Golden Visa program that was applied, it's still in place. It's via capital market instruments. So you can buy an investment fund that is eligible for the Golden Visa program. It has to invest more than 60% in Portuguese stocks. And that is being attracting many, many investors, especially from the US. Also, because Portugal is a European Union country, you have access to the single market, high safety and education metrics. Also, you have political stability within the European framework. So there's the European rule of law. And for Americans, I think that the lifestyle, resilience, and without leaving the capital market quality, it's a plus, because you can still be invested in the capital markets, making a good return. As you mentioned, the Portuguese market last year was up 30%. If on top of that you add a 14% depreciation of the dollar, you are talking about 45% appreciation in dollars. So Portugal has become, I think, a small gem and is being discovered by Americans. It's an alternative for investment. Also, as it's a small market and a very profitable one, I think it's now just on the beginning of being discovered.
Nice. So, correct me if I'm wrong, Pedro, because you're a smarter and better dressed man than I am. For years in the United States, as an investor, we would look at being invested in U.S. small, large, and medium cap stocks, a little bit of bonds and cash as sort of the core portion of our portfolio, and then investing in European markets and even emerging markets would be considered a core portion of your portfolio. But it sounds like everything I'm getting from you is that the world is changing, as Mark Carney said, and we need to start thinking at things differently. And if you're a U.S. investor and you still want to have a growth strategy, it sounds like we need to start thinking about how we can incorporate international investments as more of a core portion of our portfolio and not necessarily look at all international markets as sort of an explore or an aggressive portion of our portfolio. Is that accurate?
Yes. So I think that U.S. investors have to start thinking about diversification in currencies, but not only currencies and markets, but also dual custody. So usually American investors have all their assets in U.S. institutions. And you have to think about the plan B or plan C, which is we have now clients that are asking if we can have accounts or management accounts with shares and bonds or financial instruments custody in Portugal. And what I think that the trend that we are seeing is that people are always also diversifying the custody countries. So this is also a plus because Portugal, as you know, is a member of the European, so you are under the European regulation, and you have diversification in euros. You have dual custody possibility, and also the possibility of accessing to a passport. So I think it's an unbelievable opportunity to have a plan B. And I think for those that can, and for all of us, under this world that is more and more volatile and uncertainty, full of uncertainty, for those that can, this should be mandatory.
Well, David and I could continue this conversation all day long, but I feel like the next time we continue the conversation, it has to be on the Mediterranean with some Vino Verde. So thank you so much, Pedro, for joining us today. We appreciate it.
Thank you so much for having me, and I hope seeing you in Portugal soon.
We encourage you, especially if you're retiring abroad or early like us, to follow in our footsteps and start considering, with your financial advisor, of course, how you can incorporate more global assets into your portfolio.
And if you'd like to learn more about the Optimized Investment Partners Portugal Golden Opportunities Fund, subscribe to the Queer Money podcast on YouTube and our newsletter, as we'll discuss more about that. Thanks for tuning in.
If you like what you see, scan the QR code to follow Yahoo Finance podcast for more videos and expert insights, because when you do, you'll become wealthier too. Until next time, stay fabulous.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.